Republicans must resolve the differences between the House and Senate versions of their tax overhaul bill before they can pass a final version. Both versions include substantial overall tax cuts for individuals and businesses, but the details vary, resulting in different outcomes for different groups. The tax cuts are similar, but the final bill may have to look more like the Senate's version. Both bills would lower individual tax rates overall. But to comply with Senate budget rules, the individual tax cuts in the Senate bill would expire after 2025. The final version of the bill will still have to comply with the rules, so it's likely that the bill will also let major provisions expire. Current House-Senate number of tax brackets. Current House-Senate number of tax brackets 747 expires after 2025. Top rate. Current House-Senate top rate 39.6%, 39.6% with a 45.6% bubble rate for some top income. 38.5% expires after 2025. Starts at current House-Senate starts at $426,700, $480,050, singles couples $500,000, $1 million, $500,000, $1 million expires after 2025. Alternative minimum tax. Current House-Senate alternative minimum tax. Alternative income tax calculation for high-income taxpayers repeals keeps but increases exemption so fewer will pay. It expires after 2025. The cuts would shrink over time for everyone but the wealthiest in both bills. The highest earners would still receive a boost in after-tax income by 2027 because they would benefit more from the corporate tax cuts, which would not expire in either bill. Change in after-tax income in the House and Senate bills. Income in 2018-2019 Indiana 2027, lowest quintile less than $25,000, second quintile $25,000. 48,600 middle quintile $48,600, 86,100 fourth quintile $86,100, 149,480th 90th percentile $149,400, 216,890th 95th percentile $216,800, 307,995th 99th percentile $307,900, 732,800 top 1% $732,800 and up top 0.1% $3,439,000 and up. Source: Tax Policy Center. Data for the Senate plan in 2018 is not available. Both bills expand tax credits for families, but they have different expiration dates. Both versions would repeal the personal exemption in favor of a higher standard deduction and expanded tax credits for families. While the child tax credit is slightly larger in the Senate bill, and people with higher incomes would be eligible, it expires after 2025. The new family tax credit in the House version would benefit more types of people, but it expires even sooner. Current House-Senate personal exemptions. Current House-Senate personal exemptions $4,150 per taxpayer. Independent repeals expires after 2025. Standard deduction. Current House-Senate standard deduction $6,500, $13,000, singles couples $12,200, $24,400, $12,000, $24,000 expires after 2025. Child tax credit. Current House-Senate child tax credit $1,000, $1,600, $2,000 expires after 2025. Family tax credit. Current House-Senate family tax credit none $300 for taxpayer, spouse, other dependents expires after 2022. $500 for non-child dependents expires after 2025. Credits phase out starting at current House-Senate credits phase out starting at $75,000, $110,000, singles couples $115,000, $230,000, $500,000 expires after 2025. Both bills include new restrictions for those claiming the child tax credit. Under the House bill, children would be required to have a Social Security number to be eligible for the child tax credit, and parents would have to have one to receive the refundable portion of the credit. The Senate bill would require each child to have a Social Security number to claim the refundable portion. The Senate bill is slightly more generous. The House bill would scale back the mortgage interest deduction, cutting it by up to half. Both bills would repeal the deduction for home equity loans. Current House Senate mortgage interest deduction. Current House Senate mortgage interest deduction can deduct interest payments on up to $1 million of debt limited to payments on $500,000 of debt. Repeals for home equity debt. Repeals for home equity debt expires after 2025. Residences. Current House Senate residence is principal and one other residence. Principal residence no change. State and local tax deduction. Current House Senate state and local tax deduction. Income or sales and property taxes are deductible. Repeals all but the property tax deduction up to $10,000. Repeals all but the property tax deduction up to $10,000 expires after 2025. The Senate initially included a repeal of the state and local tax deduction in its bill but later changed it to match the House version, retaining a $10,000 limit for property tax deductions. Lawmakers are considering scaling back the repeal even further in the final version to allow people to deduct up to $10,000 in income taxes or in property taxes. The House bill is better for those who would owe the estate tax. Both bills would scale back the tax, so only larger estates would be affected. But that change expires under the Senate bill, bringing the threshold back to its current level after 2025. The House bill would repeal the estate tax after 2024. Current House Senate estate tax. Current House Senate estate tax top rate of 40% on estates above $5.6 million. Increase threshold to estates above $11.2 million. Then repeal after 2024. Increase threshold to estates above $11.2 million expires after 2025. The House bill would repeal a significant deduction, but the individual mandate repeal in the Senate bill would have broader effects. The House bill would repeal the deduction for medical expenses, a tax break most important to low-income individuals with high out-of-pocket healthcare costs, though some House Republicans support retaining it in some form. Current House Senate medical expenses deduction. Current House Senate medical expenses deduction can deduct out-of-pocket expenses in excess of 10% of adjusted gross income. Repeals expands by reducing threshold to 7.5% of income. Applies to 2017 and 2018 individual mandate. Current House Senate individual mandate penalty for not having health insurance no change. Repeals but the Senate plan would repeal the Affordable Care Act's individual mandate, a requirement that everyone must buy insurance or pay a tax penalty. The move could save lawmakers $338 billion, but it would be a significant blow to the Affordable Care Act, resulting in an estimated 13 million more people without insurance and higher average premiums. Lawmakers have said that it is likely that the repeal will be included in the final bill. The Senate plan makes fewer cuts to existing tax breaks. The Senate bill would leave in place several education tax breaks that are repealed or changed in the House bill. It also would double a deduction for teacher expenses that the House bill would repeal. Current House Senate education credits. Current House Senate education credits. American Opportunity Tax Credit, Lifetime Learning Credit and Hope Credit consolidates and slightly expands the AOTC no-change student loan interest deduction. Current House Senate student loan interest deduction can deduct up to $2,500. Repeals no-change graduate student tuition waivers. Current House Senate graduate student tuition waivers. Tuition waivers are not treated as taxable income. Repeals no-change deduction for classroom expenses. Current House Senate deduction for classroom expenses $250. Deduction repeals $500. Deduction expires after 2025. Both bills would expand the use of 529 college savings plans to include private school tuition for elementary and high school students. The House plan would also allow an account to be opened for a child in advance of birth. The bills both include deep cuts but go about it in different ways. The two versions differ on how to tax pass-through business income that is currently taxed at the individual rate of the business's owners. The House bill sets a lower top rate with an exception for professional service businesses like in law or accounting. The Senate bill creates a new deduction for pass-through income. Current House Senate top pass-through rates. Current House Senate top pass-through rates. Top rate of 39.6%, top rate of 25% with the Exclusion of professional service income 23% deduction, phasing out for professional service income beginning at $250,000 expires after 2025. Overall, the tax cuts are deeper in the House bill. The sprawling corporate changes would be permanent in the bills, which both include a top corporate tax rate of 20%. Lawmakers are considering raising that rate to 22%. For other changes to the reconciled bill. Current House Senate top corporate tax rate. Current House Senate top corporate tax rate 35%, 20% delayed until 2019. New investment purchases. Current House Senate new investment purchases. Complex rules for deducting over many years. 5 years of expensing, then phased out over 5 more years. Section 179 expensing. Current House Senate Section 179 expensing. Small business expensing limited to $500,000 increases limit to $5 million increases limit to $1 million. Business interest deduction. Current House Senate business interest deduction generally wide deductible caps deduction at 30% of income including depreciation caps deduction at 30% of income excluding depreciation alternative minimum tax. Current House Senate alternative minimum tax alternative income tax calculation for businesses repeals no change in a last minute change to its bill. The Senate also maintained the corporate alternative minimum tax, a decision that has resulted in blowback from several industries and could be reversed in a final version. The Senate bill also makes fewer changes to corporate tax breaks like energy tax credits and private activity bonds. Current House Senate orphan drug tax credit. Current House Senate orphan drug tax credit for 50% of qualified testing expenses repeals reduces credit rate to 27.5%. Renewable electricity tax credit. Current House Senate renewable electricity tax credit for wind power production, phasing out by 2020 scales back the size of the credit. No change. Private activity bonds. Current House Senate private activity bonds tax-exempt bonds used to fund low-income housing and other projects repeals no change. Both bills shift to a new system in different ways. Both bills would move from the current worldwide tax system, in which income earned abroad is taxed in the United States, to a territorial system in which only domestic profits would be taxed. They each would use different mechanisms to prevent companies from shifting profits abroad. Current House Senate taxation of multinational companies. Current House Senate taxation of multinational companies worldwide system with deferral and credit for taxes paid abroad. Modified territorial system with new foreign payment excise tax. Modified territorial system with new anti-abuse tax. One-time repatriation tax. Current House Senate one-time repatriation tax, 7%, 14% for cash, 7.5%, 14.5% for cash. Sources: Bipartisan Policy Center. CQ Roll Call. Heritage Foundation Joint Committee on Taxation. Tax Foundation Tax Policy Center. Note: references to couples refer to married couples filing jointly.